So we can get going, I think. My name's David Marsh. I'm the chairman of OMFIF. Thanks very much all for coming along this evening. The idea today is to have a very interactive discussion with you in this auditorium. This is the kind of place that used to be modern, I think, about 20 years ago. And so they had this wonderful idea of putting these microphones in, which does mean that you can interrupt at almost any time. And therefore, please do feel free to have a dialogue with the panel that will take place. And also when Taylor Pierce in a moment is giving the presentation, if you've got any points or questions or interrogations or comments, please interrupt her. She likes being interrupted. She's a bit like Chancellor Helmut Kohl. She always performs better when she's being interrupted. But the point about this GPP is that we've been looking now at these official monetary and financial institutions now for some time. And we decided we would try to segment some of these institutions. We do the central banks in a different way, and we put the sovereign funds and the public pension funds into another basket. So we've subdivided this year, and we thank also Citibank very much, who are here today with us because they've been giving us this support now for 4 years. And so there are a number of findings here which have to do with the rather gloomy outlook and the rather gloomy state of affairs the world is in. And there has been something of a change, it seems, compared with the mid-year when we did our survey for the central banks and what we have done now more towards the end of the year for these longer-term institutional investors. And I will obviously leave Taylor and Nikhil and Neil Williams, my colleague, to go into this a little bit more. But the point is we do rely a huge amount on people giving us their time and their initiative and their insights for these surveys. So those of you who are in the audience on whom we've relied, I'd like to say a big thank you. And those of you who'd like to contribute in some way with some ideas and some initiatives and some thoughts for next year, then please do be quite free in telling us what your thoughts are. As I say, I'd like to have a really interactive time here. So let's go over to Taylor straight away to lead us into the presentation. Taylor, thank you for coming over from Berlin today.
Thanks, David, for that introduction, and thank you everyone for joining us today. My name is Taylor Pierce, and I'm economist of OMFIF's Economic and Monetary Policy Institute. And I'm delighted to share the key findings of our report today. We've been working very hard on this over the past few months, and I'm very excited to go through the findings with you. So let me just make sure I have my clicker for the slides. Producing David. There I am. Okay, so just to give you an introduction of global public pension, this is a report which we've done a little bit differently this year to previous years. You might be familiar with our flagship report, Global Public Investor, and we survey central bank reserves managers, public pension funds, and sovereign funds. So this year we decided to split those survey into 2 reports. So we released our GPI, which was an analysis of central bank reserves management asset allocation in July, and this is the second iteration of the report. So we surveyed 19 funds across the globe, so sovereign funds and pension funds, with over 3 trillion in assets under management, covering Europe, North America, Middle East, and Asia Pacific, so pretty global spread. And this was also supplemented by our research of annual statements for the top 100 pension funds and the top 50 sovereign funds by AUM. We focus in the report on asset allocation, ESG, and we included an additional new section this year on operating models and data. So I'm going to walk you through each of those sections now, beginning with a macro view of funds. So to start off, we see that the risk of stagflation is looming very large for the funds which we surveyed. We asked funds what the most important economic challenges affecting their investment approach over the coming 2 years is. And we found, as you can see here in the leftmost columns, that persistently high, global economic slowdown and inflation are the top concerns. We also asked what funds' top concerns are for the medium to long term, and we found that 50% reported persistently high inflation as a key concern. So this suggests to us that funds expect a period of stagflation and they're not expecting inflation to disappear quickly. So how is this affecting their investment strategies? On asset allocation, we find that funds are becoming more active and more conservative in their strategies. So based on our survey data, funds appear to be taking a risk-off strategy and they're hedging for inflation. As you can see from the top two bars of this chart here, over the next 2 years, more than 40% of the funds surveyed are planning to allocate more to real estate and infrastructure assets. We can also see anticipated increases in inflation-linked government bonds and commodities. And we see that they're looking to put cash to work. So here we see inflation hedges in the top three, the bars there. We see a net decrease, those gray bars in the next three bars down. And we see that they're looking to put cash to work. This brings me to our next key finding on currency holdings. So we also see a flight to safety in terms of currency holdings anticipated over the next 2 years. So in the dark blue bars here on the left-hand side indicate an anticipated increase in currencies. So we see that the US dollar, euro, yen, and Swiss franc are anticipated to increase, whereas toward the bottom of the chart, we see a small reduction in sterling allocation. And interestingly, we see that while some funds are planning to reduce their investments in our renminbi, none are planning to increase their allocation to the Chinese currency, which is also in line with another finding from our report that global public funds are turning bearish on China. This is the first time in recent memory that an OMFIF survey of global public investors, whether it be central bank reserves managers or public funds, public pension funds and sovereign funds, show a reallocation away from the renminbi. The reasons for this trend are clear and also varied. As we can see from the leftmost column of this chart, geopolitics tops the list of concerns, with over 70% citing geopolitics as a key factor which would discourage a fund from investing more in China. The worries go deeper than just geopolitics, however, as we see that more than 50% of funds have cited market transparency, the regulatory environment, and capital controls as negative factors. Despite this, we did, from another question, find that almost 85% of the fund surveys are still holding Chinese equities, with more than 70% of respondents citing diversification as the main driver for this. But this turn away from renminbi is an interesting reversal from the previous few years, which we've seen. So in spite of subdued appetite for Chinese investments in renminbi, we do see a continued drive for more foreign holdings anticipated by the funds which we surveyed. So for some time, pension and sovereign funds, particularly in fast developing markets with large savings but smaller local markets, have sought to diversify their holdings away from their domestic markets. So we wondered if this year volatility and uncertainty would lead to a repatriation of funds, but it does not seem to be the case based on this data. So as you can see from the gray bar in the lower right-hand side, around 15% of survey respondents say they'll decrease their domestic holdings over the next 2 years, while 30% or almost 30% plan to increase ownership of foreign assets, which is on the lighter blue on the top bar there. And this is a continuation of a trend that we saw in 2021, so this doesn't seem to have changed this year. So the final key finding, I just wanted to mention that we're not sure, we can discuss this in the panel, but many of the funds which we surveyed are not in the US. So this could also not necessarily be at odds with the risk-off strategy, which I discussed. It could be a flight to safety to the US market. We also see that many funds are willing to grow yield-enhancing activities. Despite some of the volatility we witnessed in the UK pension market in recent months, only 5% of respondents say that they will decrease their use of derivatives, securities lending, or collateral management. That's the right-hand column here. And in contrast, over a quarter expect to grow the use of hedging, including through derivatives, the column to the left. And in the left-hand two columns, we see that close to 40% intend to expand collateral management activity as well as grow securities lending. So taken together, these are just a few of the key findings on asset allocation from our report. So be sure to check out the whole report for more detailed analysis of asset allocation strategies, as well as a chapter devoted specifically to all alternative asset classes, including real estate, infrastructure, and private equity. To continue, we also ask a series of questions on ESG investment. So we found that this year, funds are beginning to walk the walk in sustainable finance. So regarding the long-term challenges affecting their investment approach, climate change was reported as one of the top 2 long-term concerns of more than 50% of survey respondents. So we see that funds are thinking about this. It's a key concern. We also see that this is translating into action. As you can see in this chart, over 80% of respondents plan to invest more in renewable industries. And almost 60% say they will allocate more to transitioning fossil fuels and or emissions intensive industries. So we ask a question as well on ESG investment, and this trend is also apparent, the growth in ESG considerations. So 50% of funds plan to increase allocations to green bonds over the next 2 years, while more than 40% expect to invest more in sustainable equities. It's worth noting, however, that the lack of reliable data remains a problem for ESG investments, and 75% of funds reported this as a key obstacle to further ESG adoption. To continue on the topic of data challenges, we found that data more broadly is presenting a challenge for the funds which we surveyed. This is a new section we've included this year in our survey on data and operating models. And it seems that few funds feel they have an operating model that enables them to optimally manage their fund. As we can see in the leftmost column here, more than 80% of funds state that building or improving internal data management systems are their main data priorities over the next 2 years, which is in line with funds reported technology challenges. And we see that integrating new technology and tools, security issues, and costs are all key issues for a majority of funds. We also asked a question on operating models, which found that internal, administrative, and government setup was the most commonly reported obstacle in incorporating new asset classes for funds. So taken together, these factors indicate that better use of data is a key priority for funds. Finally, we find that, so this is data from the end of 2021, and this is part of our desktop research, which we analyze the top 100 public pension funds and top 50 sovereign funds here. And we see that coming into 2022, public funds were in good shape, with the top 100 public pension funds growing 17% to 17.4 trillion in assets under management, and the top 50 sovereign funds growing 23% to reach 9.8 trillion. In the report, we also discussed some specific regions and even individual funds which have seen their AMU grow significantly from 2020, end year 2020 to 2021, so be sure to check that out. We also have an extensive data bank that we put together to rank the top global public funds by AUM. But in general, we find that for all the reasons that I've mentioned before, 2022 has been a very challenging year for funds. So despite this jump in AUM, preserving this capital and finding the right place to put that money will be the key challenges for a number of years to come. To wrap up, we find that funds, public pension funds, and sovereign funds have widespread concerns over stagflation, and this is prompting these public investors to shift towards safer and or diverse assets to hedge against inflation. Climate change is a key concern, and this is leading to a desire to invest in renewable industries and sustainable products, although data remains a challenge. There's a willingness to improve data systems, but also internal challenges to access new and complex asset classes and to integrate new technologies. Thank you very much for your attention. I will now turn it to my colleague, Nikhil, to introduce the panelists.
Thank you very much, Taylor, for presenting those key findings and wrapping up so succinctly our main messages from the Global Public Pensions Report this year. I am Nikhil Singhani, the Managing Director of Research at OMFIF, and I am delighted to be joined by a distinguished panel to talk through some of the key themes that Taylor touched upon earlier. Unfortunately, Thomas Lasky is unable to make it from USS, but nonetheless, we still have a great panel here lined up. So to my left here is Adnan Memon, who is the Chief Operating Officer and Head of Data and Analytics of the Business Advisory Services at Citi. I think I've got that right. You have indeed. Great. Also joined here by James Duran, who is the Managing Director of the Capital Solutions International Team at CDBQ. And completing the OMFIF sandwich is Neil Williams on the far left there, who is our very own Chief Economist. Now, Neil, I wanted to come to you first to set the scene, really. As Taylor had in her first slide, public funds are concerned about stagflation. It's obviously been a very volatile year on the macro economy. We're now in a period where there's fears over a global recession. Central banks are still in tightening mode. Inflation is still a key concern. Neil, how are you thinking about these themes as we head into 2023?
Well, thank you, Nikhil, and good afternoon, everybody. I'm told by those who know that before 6 o'clock is afternoon, so good afternoon. The problem that we have, but you don't, is that, as David mentioned, in this 70s setup, we have microphones, but we also have unusually high chairs and very low tables. So forgive me if I do look down at my notes from time to time. But thank you, Taylor, for the presentation. The thing I would say straight away is what a difference 6 months makes. Because as David mentioned earlier, in June, we launched our survey of central bank reserve managers' views. And at the time, a surprise to us was that overall risk tolerance was largely holding up with little significant, if any, move expected out of growth assets, despite all the responses to that survey having come in after the start of the tragic war in Ukraine. So in this survey that we're launching today, pensions and sovereign wealth funds, risk, as Taylor said, seems now to be taken off the table with intentions for far more conservative strategies, such as, for example, moving out to higher rated, more highly rated government bonds, longer debt maturities, and also, as Taylor said, safe haven, what's perceived to be safe haven currency. So I guess the obvious macro force there is that the tensions that were bubbling in the first half of the year, higher policy rates, inflation, volatility, and we've seen no shortage of that in the UK in August and September and October, and the longevity of the war, of course, have meant that these have just spilled over and intensified in the second half of this year. So in terms of the macro, for me, that cautious approach fits with the most likely macro base case going forward into next year. I would just warn you that few people come to me to be cheered up about the economy. But in terms of the macro scene set, before we look in more detail at the nuts and bolts of the survey, we've had 4 major global crises in the last 14 years, if you include those in the euro area. And so the question I have for next year is how and when do central banks and other policymakers get back to some sort of normal, what they would consider to be normal? And by that, I'm thinking a time where interest rates are sustainably above inflation. Remember those times? Growth is guaranteed. Central banking is boring, as Mervyn King, former Bank of England governor, once said it should be. And also it was governments that did fiscal policy. Central banks stood back. The answer I come to when I think of those things is not for some time yet. We know that central banks generally are raising rates quite hard into the Northern Hemisphere winter. So what could possibly go wrong? We know that they're either doing or talking about active quantitative tightening. I suspect they will have to go very light on that while government debt ratios remain high. A great deal, in my view, of the inflation you've seen is still the wrong sort of inflation, cost-led rather than demand-led, but it would be interesting to hear your views. And also, I wonder if longer term, the disinflationary forces pre pre-war are still waiting for us and might become more visible if we move towards the end of 23, or even into 24. So just before we hand back and talk about the survey, just a few numbers, if I may, to set the scene. $20 trillion is the amount of liquidity that the big four central banks added after 2008 through quantitative easing. And to put that into perspective, that's equivalent to about 90% of the size of the US economy, or 115% of China's. And for the most part, that's still hanging out there. This liquidity injection to the private sector is still there. So I wonder if what was the solution increasingly is going to become part of the problem in terms of trying to wind that in. So just to wrap up on the macro side, looking into next year, a big challenge for me, a big question mark, one of which I'm not too optimistic, is how the policymakers and central banks can get back to normal without the unintended consequences of potentially longer and even deeper recessions. And it was interesting to hear one of the Bank of England rate setters mention this at the weekend. And in terms of an analogy, what I have in mind is that as the tide of liquidity goes out, as the central banks and policymakers start to normalize, what are the sharp rocks that they expose? And maybe one of those sharp rocks we saw here in the UK in September and October, when liquidity had to be added to help the pension sector. I'm not quite convinced those sort of strains are yet behind us. And I say that to Nico to then take us into the discussion about the escalation.
Thank you, Neil, for setting that gloomy tone, really, on how to look at the macro backdrop going into next year. James, I wanted to come to you just kind of with that in mind on central banks withdrawing liquidity, raising interest rates. This sounds like something that might be negative for the outlook for fixed income. How do you see the outlook for fixed income products going into next year and beyond?
Yeah, I mean, it's a really interesting point. And I think maybe first you have to put in perspective how big fixed income is as a piece of the asset allocation of many funds. So in CDPQ, we're about 400 billion Canadian dollars of assets. About 130 billion of that is across the fixed income and the credit portfolio. So it's just a massive part of the ecosystem. And so even if the outlook is negative, it's still going to be a very important part of your asset allocation and very important actually for managing liquidity needs in the short term. I think what's interesting, if you put it into a bit of perspective, right? You've had two moves here. You've had a rate move and you've had a spread move. And actually, the big piece of turbulence in the fixed income markets has all been about the rate move. I think it's been the worst in 60 years in terms of speed of rate increase. And if you look at sort of the impact on some fixed income portfolios, that's been the big driver. If you look at credit spreads, by contrast, they were incredibly tight at the beginning of the year, reflecting all of the quantitative easing and money in the economy. Now they're about back at their long-term average. So they're you're actually as an investor now beginning to get paid for investing in fixed income. And that's quite an interesting thing. As we think about the fixed income portfolio, you've got to remember it's not static. We're not investing in 50-year duration bonds and just leaving them to sit there. We're investing in the real economy. That could be in corporates, it could be in infrastructure projects, it could be financing the construction of buildings or similar. And in those things, actually that portfolio tends to repay very quickly. Generally, somewhere about between a quarter and a third actually recycles every year and comes back to us in the form of repayments and maturities. So there's an interesting paradox. So although the market has been difficult over the past 6 months, you're actually getting money back on a constant basis, and you're actually able to redeploy at very attractive levels. So yes, you've had pain on the one hand, but on the other hand, you're now on a forward-looking basis actually seeing quite interesting conditions to put money to work, both from a rate perspective and from a spread perspective. Doesn't mean we won't have more volatility. I think that we're all very aware of that this unwinding of quantitative easing won't be easy, and I'm sure there will be more bumps in the road. But at least I think now we're in a position where fixed income was incredibly tightly priced, and now actually there's much more value there for investors.
Yeah, thank you for that. I think that speaks to some of the themes that came through in our survey, really, that funds are looking to be more active in this environment because there's more. It's kind of things have been thrown open now in this environment where you're possibly seeing more attractive yields. There's, as you mentioned, fixed income is not just one monolith right now. And actually, Neil, I want to come back to you to kind of dig into a bit more of the details on some of the survey findings that we had. Some of the things we noted, for example, just building on James's point on credit, for example, it seems like there was a shift to, well, funds are looking to shift into more higher rated government bonds, for example, is one of the things we found, which is consistent with this general theme of a potential flight to safety. Could you expand on that and some of the other points that came across in our survey in terms of asset allocation?
Yes, certainly. It was interesting what James said about yields and spreads, again, looking attractive. That may sound completely bizarre to somebody who's not been looking at markets for a decade or more, but I guess it's a step closer to what used to be called positive real yields. I'm never sure if you're negative on negative yields, if that makes you positive, but just to confuse everybody. In the survey, I mean, there's a lot there, but maybe it's as a dire economist, these are the things I picked up on. But I think there's a very clear theme in the survey, especially compared to the one earlier in the year, which is that there has been a mood shift and intended asset moves are consistent with that. Something that Taylor, I think, only touched upon, but it is important, is that the main drivers for investment are cited, again, as target return and capital preservation, as they were last year. But there's an increasing proportion who are putting preservation ahead of return. And I say that because it seems to fit with the old adage in bear markets that it's the return of your money that becomes more important than the return on your money. So that's the first thing that got me thinking. Within that, looking at the asset plans, there's quite a few inflation protectors there. There is increased allocations to, in order, in fact, real estate, infrastructure, and inflation-linked bonds. And also commodities. And given the other reasons cited more broadly in the survey, I would imagine the attraction there of commodities is not just the inflation play, but also the geopolitics, which Taylor mentioned as an increasing concern going forward. On the government bond side, which James mentioned, there's little discernible flight expected from government bonds, even with these historically, I think we can say historically still, low nominal yields and certainly real yields, despite inflation being a concern and also a lack of fiscal repair globally. So government bonds are certainly not off radars. And so putting this together, there are four things which I'll touch upon briefly, if I may, which cry out to me that this is a far less risk-on attitude from this survey than either of the 2021 pension fund survey we ran, or the earlier this year central bank reserve managers. So there does seem to be a shift in sentiment. Very briefly on those four, the first one, allocations to equities, not plummeting, but for the first time, a net balance of funds expected those to fall in the next 1 to 2 years. That's a complete variance to the June central bank survey, where they were planning to moderately increase their allocations, or at the very least, hold their net equity positions. Second, demand for corporate bonds overall is expected to fall back. And within government bond land, there's a move both to the higher rated end, AAA, AA sovereigns, and also longer maturities. Now, to me, that's interesting, but all of this is interesting, because in the central bank survey in June, they were expressing strongly a move to the shorter end of bond markets. I wonder if that was because at the start of the tightening cycle, they felt perhaps that market expectations at that stage were overdone. But clearly now, and maybe it's a symptom of a more downbeat view on global growth, there is a net move to the longer maturities. The absence also of any upscaling expected in cash, I think, is important. Suggests to me that asset managers from the pension funds see the hit from inflation as being more important to any benefit from rising policy rates. Throw it out there, but maybe they're suspecting that we're getting close to the peak on policy rates, which hopefully at some stage is going to be next year. Fourth, intended allocations by currency and region, which Taylor touched upon. In terms of region, the winners here are North America, Europe. The relative losers in this respect, Africa, Asia Pacific, Latin America, and surprisingly perhaps, given their oil revenues and reserves, the Middle East. So if putting that together, if we can generalize maybe and say that's a net shift from emerging markets back towards developed markets, that again for me is a slightly cautious angle. And finally on China, which Taylor covered excellently, the vast majority, almost 90% of our respondents hold China. They will continue to do so. However, the drivers now, as Taylor said, are diversification and benchmarking, and very little to do with what might be seen to be more positive reasons, such as the outlook for the Chinese economy. Now, part of that, of course, may be because of the tight lockdown restrictions in China during the sample period or the survey period, but it also fits with concerns about the geopolitics and transparency that was cited as well in the survey. So there's a lot in there. Sorry for a long answer, but in sum, three things I would say summarize the survey. One is in terms of asset allocation, more active. Secondly, more conservative. And thirdly, it fits with the macro view, if like me, you're not too optimistic about next year.
Thank you, Neil. I wanted to bring up more on that point that you raised about being more active and looking to move into alternate assets. So it seems like there was, as Taylor showed earlier, there's increased willingness to invest in real estate and infrastructure. And in part of the report, we also talk about private equity as well. And I wanted to come to you, James, on this, because I know CDPQ has a big portfolio holdings in alternate assets like real estate infrastructure and private equity. It's true of many Canadian funds, it seems, as well, more generally. How are you looking at the alternate asset space? And could you share some of your experiences in CDPQ about managing such a large portfolio in alternate assets?
Yeah, absolutely. And maybe to put it in context, more than 40% of our assets are invested in the less liquid space. So that can be everything from infrastructure or real estate through to things like private debt. And I suppose the reason we can do that is we have just very, very long duration capital. So we're an excellent holder of illiquidity risk. And that enables us to do really two things. I mean, on the one hand, it gets you a return premium, whether that's in private credit or private equity. But it also enables you to put some interesting pieces into the portfolio. So if you think about the inflationary environment we're in now, having a good-sized infrastructure portfolio as we do, often many of the contracts underneath that, think about a toll road or something like that, will grow actually with, or indeed perhaps better than inflation. So it's actually quite a nice piece to add to the portfolio. I suppose we're lucky, given our scale, that we have very deep internal talent. So we do partner with external managers to manage parts of our investments. But equally, we have in-house teams who do things like private credit or infrastructure investing or private equity. So I think in that sense, having capabilities does enable you, I think, to go deeper into the alternative asset space.
Thank you. I would also just to go further on your point on external managers. We have a dedicated chapter in the publication on external managers where we're looking in more detail at funds operating models, and this is definitely a theme that comes out of it, is that many public pension funds are using external managers to navigate this alternate asset space. I just wanted to touch briefly upon that point you made about the illiquidity premium in alternate assets. Of course, there's the reward for investing in them, but there's also risks that come with it. And I think this is something obviously we've seen in this country with the volatility that happened with the UK pension markets, and it showed that in times of crisis, there's a need to have liquid assets on your portfolios just in case things go wrong and you need to raise cash. Is that something you're concerned of, having such a large portfolio in illiquid assets?
It's obviously a risk you need to be mindful of, liquidity risk. But I think it comes down to what's the balance of your portfolio, because sitting alongside a large alternative assets portfolio, which is large in nominal terms, We also have a big liquid assets portfolio, liquid bonds, liquid equities, and so forth. So I think we're in the lucky position that we, in a sense, we can balance the portfolio. You can meet multiple objectives. You can meet a return objective. You can meet a liquidity objective, and hopefully, as we try and do, meet our ultimately our clients' needs, but also manage risk.
Thank you. Just also on alternate assets, one thing we asked, we asked earlier this year in our sister publication on GPI with central banks, we asked them about the attitudes towards digital assets, and unsurprisingly, there was a very blanket, no, we're not interested right now. Perhaps unsurprising given the focus on capital preservation. We asked the same question to public pension funds and sovereign funds. Unsurprisingly, there was a similar answer, but a handful did say that they are either considering it or they are currently invested in digital assets. I think it's important to make a distinction here between the cryptocurrencies and that world that seems to be in chaos right now, and perhaps there are opportunities in digital assets more generally. Adnan, who's been patiently waiting here, I'd like to come to you on this as to how you're looking at the digital asset space and whether you think there are potentially opportunities there for funds to invest in the coming years.
Certainly, I'm going to pick on one thing that James said in terms of the illiquidity premium. I think it's important to understand if you're allocating those pools of capital, if you're simply seeking the higher yield and higher return from private assets, and that was the only thing driving your allocation, you might well have found yourself in difficulty during a liquidity crunch. If, however, it was part of a portfolio, as it would be a CAS, then you see then the firms that have been able to enrich their product mix and to be able to think across asset classes and be able to think, how do they fill out that allocation bucket and think from a more creative perspective of achieving different types of risks, achieving different types of returns. That allows you to build out and not suffer during a liquidity crisis that might be on the public market side without then having severe drawdowns on the private market side. And some of the rigidity of our industries of being able to say, well, actually what we're going to do is have 60% this and 20% this and 20% this, versus saying, here are the sorts of risks that we are willing to take on. And breaking that down and thinking more about what are the things that you're willing to tolerate within your portfolio means that you can get to a more realistic approach of what you want to do and how you achieve it. That way, you don't have to say, well, actually, my allocation to private equity was supposed to be 20%, but it's now shot up to 27% because it's held its value. Now, for some firms that have those rigidity rules within their mandates, they've been forced into fire sales of those private assets to meet the margin requirements or other risks that they to be able to balance their portfolio to get that 27% that they increased to down to 20% again. Versus others who are able to say, well, actually, that's the reason why we've invested in private assets, and not panic and be able to say, well, here's our portfolio. It will weather the scenario. It will weather this storm because we are able to get further. Now, to your point of digital assets, I think your question exactly cuts it rightly. That when we think about digital assets as a whole, most of the noise we hear in the market, in the news, is just noise. It is saying, oh, Bitcoin has done this or Bitcoin has done that. Bitcoin is an important currency within the digital asset space. It is the largest in terms of market cap and traded volume. But that doesn't mean that it's the most innovative. Ethereum, however, as a contrasting version of another cryptocurrency that we hear talked about, the second most actively traded, is a completely different system entirely. It's just completely different. Bitcoin is just a payment currency, and you can use it and you can trade it and you can use it in any way that you want to transact. But that's all it does. It will record it, and it means that you can have it available. It's immutable. It has lots of different benefits to it as a digital currency. There are other versions of digital assets like Ethereum, which have that common layer to them too. You have a payment system, you have a digital ledger, it is immutable, but there's so much more built on top of it. Smart contracts, for example, I can take CDBQ's code and say, well, actually, because you've made this code available, I'm going to leverage the code that you've made available, I'm going to build on top of it, and I'm going to make my own customized solution. CDPQ, and I'm not saying that they are doing this, but a firm that made their code available will get paid as a result because they have made it. They've got a royalty payment effectively for it being used. So I think often we are blindsided as an industry because we think, oh, well, this shiny new thing has shot up. Well, that must be dangerous because it will draw retail investors, and therefore we need to have safeguarding in place. Well, of course we do. Of course we need to have safeguarding in place. But that doesn't mean that there isn't something else behind it. And actually, when we spoke to our own client base and surveys that we've written in the last couple of years, it was amazing to me to see when we mentioned the simple 3 letters NFT, non-fungible token, how frightened people were initially. So, oh, well, that's just rubbish. We don't want to care about that. And what inherent value is there in Jack Dorsey's first tweet on Twitter? Maybe there's value to a collector, maybe there isn't. But beyond that, I can create NFTs with intellectual patent. I can say, Akhil, for example, who's built out this great idea. I'm going to leverage it. I'm going to build out that idea that the TikTok's For You algorithm, for example, and the way that it is able to put together customized baskets of understanding. TikTok, for anyone who doesn't know, is a social media. So you can build off of these types of algorithms that have been used, and you can say, well, actually, Facebook's algorithms and Google's algorithms, they're great for those corporates. But are they being sweated as much as they possibly could be? Perhaps so, perhaps not. Well, actually, what you can do is say that I'm going to buy the right from TikTok to be able to use their algorithm, to be able to say, this is how I will apply the technology to my framework, and therefore you will get paid for your creation of that algorithm. I will get the benefits because I don't have to build that very complex bit of technology or algorithm or whatever it is that you do, and say, well, let's make that available too.
I followed you. Hi, I followed you all the way, and then the bit that confused me is why can't I price all of that in dollars? Why can't I price the algorithm from TikTok in dollars? What's wrong with the dollar? Why do I need something else? Or what's wrong with the sterling? That's the bit I'm still struggling.
You absolutely can price it in dollars, and some probably will. But the thing is, if you do it within Ether, for example, or the Ethereum platform, I can build on top of it, and I can then add my code to your code to someone else's code and create and innovate between them.
Oh, I get the platform thing. I don't get the currency exchange thing.
The Ether currency is simply the transactional currency for the platform. So you need to transact in Ether to be able to use Ethereum's capabilities. And
right, I have to transact oil in dollars. I have to transact NFTs in Ether. Is that what you're saying?
That's one of the platforms.
So my question is, why can't I actually have a dollar transaction on that platform? Isn't that called the M&A market?
You do. You could buy the Ether to do so, but you need to have the participation token, which is the Ether, to be able to do that.
I think so.
Yeah, I'll take you offline. Someone's got to explain this to me.
I think which something that might help is at OMFIF we've done a lot of work on the digital asset space. We produced a report just I think about 6 weeks ago on digital assets, which tries to break down some of these themes that Adnan touched upon, like the NFTs, the underlying technology, the risks around it, and we launched a digital asset regulation tracker as well, which tries to look at what regulators are thinking about this, which I think is fundamental in all this. So I'd encourage you to and the audience, if they want to know more about this, to look through some of the reports we've done at OMFIF and check out our Digital Monetary Institute, because I tend to agree with you. And I think it's right to have a healthy level of skepticism, and of course there's a lot of chaos going on right now in the digital asset space, but I think underneath it all that there could perhaps be an opportunity there for investors. I want to move the story on a bit and touch on a completely different topic. But
I didn't want to interrupt.
Oh, go ahead.
May I? Sorry.
Sure, yeah.
I'm wondering if Adnan, if you could tell us a little bit about how those digital assets are behaving on a trend line in this environment that we're seeing other assets behaving.
I have to be careful in the way that I comment here, because my role means that I think more on a strategic level rather than a tactical level. So I'm not involved in any way with how you would price a certain part, but in terms of how firms think about how they put those together. In short, though, it's been a difficult year for many of them because of the interlinked nature of the digital assets ecosystem. So it is, even some of the most resilient firms have had difficulties because of a lack of confidence that just got cascaded throughout the industry. And some very well-funded firms have got severe problems at the moment because you've got other investors who are unwilling to engage. But I'm not by any means simply a digital asset evangelist. It's just the first topic that we came to.
Seems to have generated a good debate. Maybe want to come on to another topic, which is equally generating many headlines, and that's ESG. And it's another space where it feels like maybe there's a lot going on, and it's sometimes difficult to cut through what are some of the key ideas and concepts within it. And James, I wanted to start with you on this. On ESG, we have a chapter on this in the report itself about how different funds are thinking about ESG, both in terms of an investment prospect, as we saw on Taylor's slides. There seems to be a keen willingness to invest in renewable energy, in green and sustainable assets. Another topic we touched upon is how funds are incorporating ESG into their own investment practices, and that's something I wanted to ask you, James. And how does CDPQ implement ESG internally?
It's really integral to everything we do. So, for example, every team has a carbon budget. So, in terms of every investment we make, we benchmark the carbon intensity of that and think about overall how carbon intense the portfolio is. And we've given commitments publicly as to how we'll reduce that over time. So that's one piece of it. The other piece is how you engage with companies you've invested in on other parts of it. So the S and the G, and governance in particular is something we spend a lot of time on in perhaps private companies we've invested in on the private equity side of the portfolio. You can actually get in there and you can, for example, talk about board composition, and you can actually directly change that. We've announced targets for example, the percentage of females on boards of companies in which we're invested. On the public side of things are, you have only perhaps a more indirect influence, but we're very active in terms of how we vote. So it's quite interesting to kind of how you bring that together. It can't just be one piece of it. But I think the other piece, when I was listening to the findings of the survey, there was an interesting piece that actually really resonated with what we do at CDPQ, which is how do you finance the transition? Because I think we'd all love to live in a world where we're emitting a lot less carbon, and we've dealt with perhaps some of the biggest sources of pollution out there, but that's not the world we live in today. So a big question for us as a responsible investor is, how do you get the world to the right place? And we actually have what we call a transition envelope. We've committed 50 billion Canadian dollars to that to actually help companies move who might be carbon intense today to on specific projects that will reduce that carbon intensity. And we're very proud to have done a debt financing transaction for a company called Albioma, which is a energy generator in France and its overseas territories. And what they're doing is moving from being a generator of electricity using coal to being fully renewable. So, that's one where you can see a very, very clear plan, all the power plants getting converted and transitioned over. You can underwrite and you can very clearly see. So I think things like that to me are actually one of the most interesting, very tangible applications of ESG.
Yes, it certainly seems like CDPQ is doing a lot. Oh, yeah, we've got a question.
I have a question, which is everybody's trying to become more climate friendly, without any exceptions, and nobody's trying to become less climate friendly. So unsurprisingly, these things are becoming more and more expensive. So what happens when these things become incredibly expensive? Nobody's going to sell them, I guess. You're just going to pretend that in 40 years' time it'll all be averaged out, or do you switch within very expensive stocks, or what happens? Because clearly there's mispricing taking place within this ESG framework.
Is your question that you think certain ESG friendly stocks, if you will, are overvalued today, or what's?
Not overvalued. I advise a couple of large public sector funds. That's a real life problem for me.
Yeah.
So everybody's becoming more ESG friendly. They're going to pay more and more for these investments by definition, right? Nobody's becoming less ESG friendly. So very good climate friendly stocks will become more and more expensive by definition because of supply demand. So at what stage do you start adjusting or whatever? So Total the Energy comes out to start selling its renewable energy stocks because it regards them as being too expensive. What do pension funds do about this?
Well, I think you can take a static view and you can say, I look at a certain stock today and it's expensive, but actually, we live in a dynamic world, and I think, one of the things that we've seen is as ESG has become more important, the demand of projects, whether that's companies looking to raise equity, companies looking for debt financing, infrastructure projects, the addressable market, if you will, has actually grown. So, that I think is a little bit of an offset to it. Maybe you don't see it quite so much in the public markets, but certainly what if I look at perhaps on some of our investment committees or so forth, there's just a lot more volume coming through of those types of opportunities.
Can I give you the right answer? Which is, it's much better therefore to invest in private markets because you are putting new money into investments rather than trading in the secondary markets, which is a good point.
I don't think it's necessarily private versus public. I think it's, one of the great things about free markets is markets are reactive to change and to opportunity. So I think, you just see dynamically the economic system adjusting itself.
Adnan, could I bring you in on this? Because I know you work a lot on ESG as well.
We do indeed. I think one of the things that started to change, and exactly to your point of things being overpriced because they are simply linked to being something green, is that we're no longer simply looking for things that are just green. And that's where the majority of ESG assets have been to date. But now there's much more realization that you can build strategies around a transition story. It's not just let's buy this because it just ticked the box today and it looks positive today, but thinking about how we can make something from brown to green. And this is where leaders like us are engaging and thinking then, how do we think about that next stage? It's not just about today. When you've got long-term investors, you can think about the 10, 20-year horizon and think then, what will the risks be in 40 years, for example, for flooding risks? And we've seen Australian regulation and talked about in terms of where the climate vulnerabilities are along the coastlines and how certain banks may be responding in terms of their ability to assess risk and how much they're willing to lend against those mortgages. So we have a reactive market, as James was saying. We have an ability to be dynamic, but it's not because we are simply saying we will price something differently. It's because we're finding new opportunities. We're finding ways to make something greener than it is today. It's not just like I said, a tick the box for today. It's about finding something. The biggest problem, however, is data, improving it. I can claim that I've made something greener. Until I can prove it, we're in a different situation.
Sorry, quick question. Do you use sustainability linked bonds to finance transition, or do you use other instruments?
I suppose a lot of what we do, if I think of the areas I'm directly involved with, are often private financings. So, there'll be financing against, for example, a portfolio of power plants, or perhaps a renewables project or something like that. So it's often more project linked, and we will do project level due diligence. We may often build in, if it's a project that has, for example, CO2 intensity improvement built into it, we'll have pricing that's linked to demonstrated improvements and so forth. So that's the way we tend to do it.
And do you have enough projects? I hear very often that there are not enough transition projects. Is that the case?
Well, I suppose it depends what you mean by transition projects. So broadly, if you look at, for example, green energy or things like that, I think been very happy with the level of deployment. We're really just beginning our specific strategy around the transition envelope. I think that's gotten a good reaction from people. So I think, it's again coming back to the discussion we had earlier. You need the tools to be in place for the projects to come along often. And so whether maybe you're a corporate considering projects to reduce CO2 intensity or so on and so forth, now that there are sources of capital available, that I think may actually, if you're sitting at the board level, change some of your investment decisions, because now you know there's actually capital available. So those two things kind of go together.
I just wanted to add on to that is one of the things we found in the survey, which again Taylor touched upon, is that the key constraint here on ESG from the findings we have is the lack of data rather than the lack of available projects. So it speaks to what James is saying there, that it may be having the internal capacity to understand what opportunities are out there, gathering the right data on that, and maybe Adnan, you could you tailed off your last comment by saying that data is the
Also,
key.
Nikhil, could I just ask a question about the tools? And maybe
Yeah.
it's something you're
related
about
to
to
it.
ask me,
Yeah,
Nikhil, but all these tools, they cost a lot of money, don't they? And is this something that we looked at in the survey, the actual budgets put to this? I mean, Adnan, you might have a view on all this as well, the amount of the cost base which is actually being covered now by IT solutions of different sorts.
Those sorts of data budgets are likely to continue to rise because there are more things that we need to consider. There are more things that we are able to consider that we didn't do previously. In years gone by, we may not have considered the corporate supply chain in the same way that we do today. With EU regulations, when you have to consider from an ESG perspective, the carbon emissions along that corporate supply chain, or what that product actually cost you, what it costs the environment in terms of its CO2 emissions and water degradation or air quality, if there's been some kind of noxious gases emitted as a result. Now that we've analysed those things, we've had to spend money to try to work out how to do those things. So yes, it will increase costs if you think about it from that perspective, but it also increases opportunities. I can now map out all of those various companies along the supply chain. I can understand each of those nuances that drew us to that point that allowed me to make that investment decision. And I can now come to a more reasoned decision entirely. So it's not just starting from an ESG perspective, it helps you enrich the investment decision you've made entirely. So as I was mentioning before, when you're thinking about climate vulnerability and sea level changes and what that impact of it is, you've got a rounder investment decision versus this house looks cheap, let's buy that right now. So you can get to a point where you've got many more metrics that have been built in, greater understanding of that supply chain, and also the risks that come with it. So if, for example, as has happened, I'd analyzed Apple and said Apple is a great company that builds great products, but it has certain risks to it too. If, for example, its main factory built by Foxconn is shut down and its production is paused because of a COVID-related shutdown in China, then that has implications upon the ability for Apple to be able to produce those phones. It's not just a conceptual idea of wouldn't it be nice to think about where those things are. There were actual financial implications to them too. It's not just ESG. What may start with the non-financial and the more conceptual can really become physical reality in terms of how we trade, and coming down to the bottom line of whether or not that there's a profitable trade or not. And once you've built all those things in, you can go beyond. You can invest in that supply chain. You can think about all those other things too. But where the problems with data really come in is, as I was saying earlier, proving it. Many of the leaders that we've spoken to in the ESG space have been building out these models for years, and they've been able to deliver real returns of the financial and the non-financial. But now they're getting to a point where they're thinking, so how do we demonstrate that value? Because they're now being grouped together with lots of other managers who are thinking about how they can get into the same bandwagon, and how they are, in some cases, effectively greenwashing their products by saying, yes, we're also ESG, count us too. But now some of those leaders who are doing it are within that same group, so that you're guilty until proven innocent.
Adnan, Nav from Tata. How are you seeing that in terms of the greenium and the socium playing out, right? Because if you want to get corporates onto this journey, they'll be looking to understand what's a green interest rate versus high carbon emitting, like some of our companies in our portfolio, for example. How do you take the data points, look at the supply chain, and establish the spread between high carbon emitting and low carbon emitting entities? And how do we do that fairly around the world? Because emerging markets, we know what India is doing. India is buying discounted Ural at the moment, right? That's to power its economy. Now, does that mean we go and penalize those companies? But I think the point is that everyone's talking about data, right? Tools and models. When will we see that in pricing? And I mean, the question to yourself is, are you seeing that in pricing? Are you seeing liquidity build where you can see the spread differential? Thank you.
I'll let James and Neil come into on the pricing if they'd like. But in terms of the nuance between the region, you mentioned India. There's also a clear realization that what counts as green in Europe is not necessarily green in what's green in Asia may not be green here in Europe. And if we look at that difference between them, it goes back to what I said before. Let's buy into a transition story. It may not be green by the purest ESG standards we see here in the UK and the EU, but I'm buying the ability to reduce carbon emissions. So no, it's not about penalizing any other place. It's about finding ways to improve the metrics that are coming out, such that there is a reason to reduce it, to improve it, to drive towards that greener, positive, brighter future that we all theoretically all want, but it's just about how we achieve it. And that's a point where many managers are struggling. Managers, pension funds, other institutional investors.
I think the regulator needs to have a rethink, though. It's fine. That's not coming out from the regulator. Sorry.
I guess part of the issue is as we see coming out of things like COP28, is it 27 recently? Sorry, I can't keep up. There's a COP15 coming up soon, which seems to be throwing everything off. Is that just global standards more generally just don't seem to be on the table right now. Different countries have different priorities, and I think it's being reflected in the way, if you don't have standards at a global level, then equally at markets it's very difficult to understand what's the way to think about different green assets. And I think that's going to be one of the challenges going forward, and for us at OMFIF, we're continuing to explore this theme in more detail. Before I take more questions from the floor, I want to encourage those who are tuning in virtually and on demand. I think there should be a Slido option to post any questions you have that I can pass on to the panel. But for the meantime, are there any other questions from the floor here? Yep.
Damien Mercier. Just to sort of follow on from the chap behind me, really, in terms of trying to mechanize that, because there seems to me to be a lot of chicken and egg here. And until you build up a head of steam or some element of momentum, you can never establish the spread. How do you get comparative statistics from where you would otherwise be to where you then could be, should you follow a green path or a non-green path? So I guess in your role as fund managers, fund advisors, fund holders, not that it's incumbent upon you, because that then could easily be seen as a government role, but as leaders in this area, are you attempting to evangelize this amongst your client base and say, well, yes, there is an element of faith here because the data isn't in, because simply those returns are not back yet. But should you follow this route, then you are, to some extent, buying in the moral coin that has worth in the marketplace.
If I am actually sorry, could you turn on the microphone? I think that's just come off. Yep. Thank you. Yeah, I think James, I want to just slightly rebrand it as to why is it in that sense? Why is it that CDPQ thinks that ESG is so important? Is it that it feeds into the potentially positive returns that you can contribute back, or is it also this moral angle there as well?
I mean, to me, it sort of comes back in many ways to the fundamental mandate of CDPQ. So we are set up under law in Quebec to do two things: to deliver good risk-adjusted returns to the people of Quebec, who ultimately, it's their pension money that we manage, and also to contribute to the economic development of Quebec, right? So we've always, from day one, had to balance, in many ways, that's a sort of very early variant of ESG. You know, we're centered in Quebec. How do we contribute to the economic well-being of the province where we're based, right? And I think if that's your sort of starting mindset, you're always having to think like, am I just going for, you know, the last dollar, or do I put other things into that investment decision? So I think that's always the way, you know, from our foundation, that the sort of mindset we've had that kind of underpins our approach and why ESG is important.
I think it also feeds into what we're trying to get. James and I seem to be completely in agreement on this. What is the return that you're looking for? Is it purely a financial return, or are you thinking about those wider benefits? In Cass's case, for the people of Quebec, and for the case of other pension funds, their own pensioners or asset managers, their underlying investors. You're delivering a return. It's for you to find out how you make that relevant to your end investor. Deliver a solution that actually delivers what they want, rather than somebody delivering a 6% return versus a 5% return. But that 5% return might be more valuable because it's got other things added to it, such as, for example, subsidized housing in your retirement, such as saying that we're going to improve the water quality so that you don't have to drink dirty water or buy in bottled water. Or, for example, for somebody younger, for example, they get discounts on Pepsi if they buy the PepsiCo token. There are other things that you can add into a portfolio that mean that you can think about value that is non-financial, but it's still material to that end individual. It's still material to that person, and that's who we're acting for. But to clarify, City is not a fund manager or fund holder. We are separate from that, and we see our role as being a facilitator for our clients, not to direct them to do certain things. It's to help understand the market and understand where individual clients want to go. We will help facilitate what they want to do.
No, absolutely. I mean, of course, makes sense. It's just this underlying slow shift to try and move beyond the simple monetization or quantification financially of GDP to incorporate everything else that we're all involved with.
Yeah.
Thank you.
Yeah, I think that's a separate question for economists and how they think about this, and not just kind of plans, GDP and consumption investment figures and whatnot. Any other question here? Very good.
Oh, thank you. So interested in how your transition envelope or transition projects can affect things like net zero targets, because I imagine the people of Quebec want you to, I don't know whether you put a net zero target, but then by the transition projects, you've got more carbon in the portfolio, even though you're transitioning. So how do you balance those tensions?
Yeah, and I think it's about really looking at end result, right? So the nice thing about the transition envelope is, in a sense, one could take a simple route, say, I'm not going to do anything. I have a simple target, and I'm not going to do anything that puts me above that target. So I divest from certain sectors. I don't invest in certain companies, invest in certain projects, whatever it is. That'd be a very easy way of achieving a target and show that. But I don't think it gets you necessarily the best outcome, because somebody is going to have to finance those projects. And in fact, the person who finances them may not care about the end state that project gets at. They might say, look, I'm happy to invest in something that remains dirty, right? So I think the way we look at it is by having a transition envelope, yes, you may have higher carbon in the short term, but those projects are unambiguously good because they get you to a much better place. And in fact, that's what you need in society.
Yeah.
Sorry, can I ask an add-on to that? You can probably tell by our accents we're Australian, so there's a bit of tension in public commentary from that approach at the moment. So I completely agree with you. We need good owners on bad assets to drive the acceleration. So how will you be able to explain that to the people of Quebec, or to those who may be looking at your net zero target and expecting it to have a straight line trajectory? Will you need to do a lot of public commentary around the fact that you're now going to pick up some of those previously discarded assets?
No, we were explicit about the transition envelope. That is a sort of an exception to some of the targets, the way we've constructed it.
And outside your portfolio carbon budget that you've set in the asset class teams before.
Yeah.
Yeah.
And the reason is, right, that works because you get to the right end station.
So that's the envelope.
Exactly.
I just wanted to add a follow-on to your comments, because I think that's right. The way we look at it is at the end of the day, total return is a factor is made up of quantitative and qualitative, right? So efficient capital markets have been pricing everything at quant, i.e. there's a bunch of resources that we use for free: air, water, pollution, social, demographic, all of those things. We use and abuse them under the capital system because they're free and we maximize return. The reality is the moment you start looking at the qualitative, i.e. trying to do things in a nicer way, trying to do the right thing for the planet, there is a cost, or there is essentially an alpha that gets taken away from it. So you have to accept that a pure total return, the moment you have soft benefits, is going to reduce your total return. And we've done studies and papers on this stuff, and we're doing one with a joint with one of the global sovereigns at the moment.
Depends on your time horizon.
I was just about to say, where it really matters is how you think about that saving benefit. And that is, if you think about Pakistan, of all countries, why the hell are they so interested in this? Because they've got mountains up north and climate change is increasing flooding risk damage. And so their cost in the short term is not significant. But economically, in the long term, it's far more significant. So where you're seeing countries and pension funds really, really drive ESG fundamentals and behavior are the ones like Quebec, where they actually got a lot to lose if they don't stop the economic climate change impact because of the weather pattern impact and what it does, or low landline, where they're at risk of scared of flooding damage. And so they're the ones who are actually bringing that equation a bit further forward and faster. Folks who aren't impacted, I mean, the Dutch, is it a surprise they care about ESG more than anyone else? They're the flattest land base there is, right? They've got to get ahead of this stuff. So there is a cost. Happy to send you that paper. How do you calculate it? It's time horizon based. Some people care about it in a year, i.e. Texas. And we get thrown out of meetings in Texas if we bring ESG. And we get thrown out of meetings in California if we don't bring ESG. And that's something to do with perspectives, right?
Was there a question at the end of this for a panel?
No, we do get thrown out. It was more, I'd heard this in a few places, and it's, but you can stay here. See. Yes. Yes.
Yes.
But I think in COP27 they spoke a lot about lost damage, right, and how compensation will happen between developed markets and emerging markets. But they need to just get on with it now. And this is where private finance and long-term financing comes into it. And there are a whole load of lost damage models, and I'm not going to go through all the technicals, but this is the right place to do it. But when, we need private financing to come in and really understand, what does a lost damage model mean for emerging markets? We need blended finance solutions as well. We need sovereigns in the West, not to pally funds through development funds and trying to use soft power. We need to get serious about this.
We had a question here, and then I'll come to that.
Okay, going back to your the very start, you're talking about funds trying to preserve capital more. And one kind of fairly dramatic change, really, since the survey was done, is that interest rates are going up a lot, bond yields, in fact, real bond yields, which means that the funding position of pension funds has changed dramatically. So in some cases, like Dutch pension funds, are given more inflation-linked increases to pensioners. And in the UK private sector, they've locked in the gains and reduced risk. So that seems to be a very big influence. It's post-survey, but how would you see this big windfall or whatever, big change in the situation after decades of interest rates coming down and liabilities going up? What are pension funds going to do following this increase in real yields? Public sector funds.
Yeah, I don't know if, James, if you could expand a bit more on what you touched on earlier on fixed income, and maybe Noah, I'll come to you afterwards as well, on in this kind of rising rates environment, how you're looking at things.
Yeah, I mean, it's certainly.
Sorry, I think that microphone is turned off. Thank you. Sorry.
For us, it certainly has led to some thinking about asset allocation and where we want to pivot the portfolio. I would say two in this environment, just given where you have two things going on. You have an increase in bond yields, as you pointed to. You also have inflation risk. And so there's two bits of the portfolio that we think are where we're going to increase our allocations to slightly, which is going to be fixed income to pick up the yields, and secondly to infrastructure because of some of the inflation properties. So that for us is what we're doing, just given the changes in the markets.
No, I don't know if you had anything to add.
Very little to add other than a sort of a top-down comment there, which is, I mean, two implications, I guess, spring to mind. One is that in an environment of rising short rates and long yields, what's different about this tightening cycle, as I see it, compared to others, is that central banks and governments together have their own self-interest in trying to minimise the hit, and both have self-interest in trying to keep debt funding costs down. I say that because a concern of mine, with which I will bore anyone for a long time if you wish to be.
So you've done that with me.
Is how blurred the distinction has become through QE between central banks and governments. And just as an anecdote, somebody amongst you in the crowd when we were having a drink beforehand said central banks are craving inflation because they've got to get the real value of their debt down. And that to me is perfect because it sort of proves the point that we've begun to accept and begin to think that the debt belongs to the central banks as much as it does to the government. So the second point, therefore, that follows from that is that QE and QT, quantitative tightening, will probably not be symmetrical. QE was hard and fast, and quantitative tightening is going to be difficult. Central banks are in a bit of a pickle with this in terms of being able to using QT as an extra lever to get back to some sort of normal position in monetary policy at a time when generally fiscal deficits and government debt ratios are still very high. And despite the sort of fiscal repair we had in the UK last month, which sort of filled a hole left from the previous administration, there is still a big hole. And even that, compared to the March debt numbers, and I'm using the UK as the example, is pushing back far further the peak in the debt ratio to a point that it's 2 to 3 times higher, depending how you measure it, than say Japan's was when Japan limped into its lost decade in the mid-90s. And into next year, we're looking at Japan commemorating its 25th year of QE because it cannot afford to let yields rise. So excuse the long answer, but it seems to me the scenario we're in is one that it's in all institutions' interest generally to keep a clamp and to keep short rates and long yields down for as long as possible. I think.
Can I just ask a question on that, Neil, maybe to put to James, because after all, you've got the central banks who, on the whole, do have too many government bonds on their books, and some of them are making losses from this. As we know, they've got an interest in offloading some of this at prices which are maybe not too cheap. You know, with your 140 billion Canadian dollars of portfolio, you've obviously got remarkable insight into this, James. Should there not be room for the pension funds to be doing back-to-back deals with central banks of certain sorts, so both sides help each other out? I mean, some of this may be slightly anti-competitive, but I'm just wondering whether there's an opportunity for you here.
It's not something I've ever contemplated before, actually. So,
well, you heard it here first.
It would be for the public good.
Well, I suppose the big challenge is on any transaction, that's a two-sided transaction, right? And and I'm sure all pension funds, they have a fiduciary obligation to the pensioners for whom they manage money. And so could they realistically do a transaction, that perhaps transfers, reduces the loss to a central bank, but implicitly lowers the future return to those pensioners? So I think it's very difficult when you start looking at those types of transactions to figure out, is that really a balanced and fair transaction for both sets of stakeholders?
Well, we could discuss it over a drink later.
Thank you, David. I think we have a question over there.
Yes, and I had a question. So a follow-on for new models to come from private finance. I was wondering, for the public funds, is there an interest to use blockchain to measure and verify impact? In our PE funds, we've been able to build models through smart contracts to measure the impact of our portfolio companies. That's at a smaller scale, but we've been able to link our investor impact to our company impact through smart contracts. So that's just a question for the public funds. Is there an interest there to be able to utilize the underlying DLT technology to be able to measure both positive and negative effects of your portfolio?
Yeah, I think Jay, I don't know if you have any experience with that. Otherwise,
I would say that's I'm just a sort of humble credit guy, so I'm going to say that's probably something more than Adnan, I'd say,
Yeah,
come across.
There's certainly desire to do so. The technology capability data is not yet there. And there's also the underlying question of primary issuance versus secondary trading. So you can have an impact upon the primary side, but this is an area where there's still going to be a lot of discussion. That what's your impact if you are a secondary purchaser of an issuance? It was already doing that impact because of the primary issuance and the way that it was bought and the way that it was sold through the market. The question then is, how do you measure that impact if you are a secondary trader within that? Have you made an impact upon that? Have you made it easier for somebody to go and be the primary? That's one way you could potentially justify it. Or the most cynical view that I've heard is, no, you haven't had an impact because you simply bought what was already in the market was already pricing it, and therefore all you are is a participant along the way. You didn't actually have it. That's the most cynical view. But I think there's a whole range of views, and I think we are yet to see them tested out, and how you assess that is going to be crucial. And it will have a significant impact on the way that we think about the development of ESG as well. As what is your impact? What is the additionality that you've driven versus a claim?
Right, because we're still at the early stages of the technology, but as it starts to scale, especially for ETH, right, which is probably the most advanced in the smart contracts. But there's a link that we see even at the venture capital level.
Microphone.
Okay. And so there's a link that we see even at the venture capital level in measuring impacts, that as the technology through ETH becomes more advanced, that it will also be able to measure ESG and impact in a more nuanced way. So it'll be.
I agree. I think it's about how you apply the technology and how corporates choose to become more visible. There's also a reason why some companies stay private, because they don't want to disclose those things, because they want to have that insulation from public market pressures of continuous reporting. And it's why we've seen such an appetite from firms to spend longer and longer pre-IPO or not IPO at all. And also why investors bluntly have sought out those returns, because they can find an advantage by sourcing those companies before they come to the public market, and therefore they can enjoy the high yield that comes with that. The illiquidity premium that we all talk about is there for a reason. And I think that's going to take a while as we think about all sorts of technologies that come through. And when we think about basic tokenization of securities, we can already do that. It's just that there's an embedded infrastructure in place that works. And it's about at what point do you find that there's a good point to transition away from existing infrastructure to a newer digital enabled infrastructure that allows you to say it's worth spending this money to do that. And this is the point to do that. My view on that is when central banks create their own digital currencies.
So I think these come off. That's another interesting point, and another topic that we look at extensively at OMFIF as well on CBDCs. I think that's certainly something to keep an eye out over the next few years. Unfortunately, we only have time for two more questions, which we have here, and then I'd encourage everyone to continue the debate outside. But yeah.
Thank you. Taking a slightly different tack, I think earlier in the comments you mentioned that the dislocation in public markets meant that private assets are now a larger proportion of some clients' portfolios. I'm just wondering on your view of the impact of that dislocation on the private markets and whether we're waiting for the catch-up in the valuation of those, which is just broken by the valuation cycle. And particularly when you look at the impact on, say, higher growth businesses which have been valued into the future and the whipsaw they've had this year, could we see a similar move in private markets that's just not visible at the moment?
Private markets haven't really undergone such a period of stress previously in the way that they are today. They weren't nearly as mature during the financial crisis. It was a much smaller amount of money being managed. So it's difficult to say with certainty about how they will perform accordingly. But what is clear is that there's been a huge appetite for them historically, and that private equity firms and private debt and infrastructure firms have got record fundraising behind them, such that there's trillions of dollars waiting to be deployed in private assets because investors have looked for those yields. Until there's a reason to change that picture and understand what's going on, it may take a while for that to play through. That said, it's not totally rosy picture in terms of how we've seen private funds think about their own allocations, where they've been using continuation vehicles or using interval funds to think about how they can keep the most profitable parts. The most cynical perspective you could claim is that they're trying to do that to ensure the valuation stays as high as possible. The most cynical. There are also healthier views, which are that more optimistic views, which are that they're doing it because they can help enhance value for their end investors, and there's little value in handing something off when it is potentially undervalued, and therefore you can continue seeing that corporate growth. But again, I go back to what I said earlier. There's a reason why many corporates choose to stay private, and that's because they can have that ability to iterate and develop without scrutiny of public markets. So the reasons why you want to stay private, there are reasons why investors would want to look at privates. The valuation may take some time to play through, if it ever does, because we may have seen the public markets pick up by that point. But there is still uncertainty there in terms of how we'll see that play out.
Just time for one final question here.
I was just going to follow on from the comment about distributed ledger technology and smart contracts, and I see a huge potential for that to create accountability as well as measurement of impact, but also transparency. So, and that's going to really solve some of the issues with greenwashing. And so once it becomes of sufficient scale, those who aren't being transparent on what they're doing, I think are going to have real challenges with capital compared with those who are, by using smart contracts and having their processes transparent. And back to your question on why not fiat currency in those Web3 deals, it's the brokerage at the moment that's preventing it. So the on-ramps and off-ramps are very expensive to get money in and out of digital to fiat, but that's where the central bank digital currencies come into it. Solve that problem.
Thank you. And yeah, I think on that note, unfortunately, we'll have to leave it there with this conversation. We've gone over the dedicated hour that we've had for this. I think it's been a lively debate. So I think we touched on a lot of topics, starting from the gloomy macro backdrop that Neil introduced. That seems like a while ago now, doesn't it? Touched on ESG, the various issues and opportunities with that, and data, blockchain technologies, and all the rest of it. So I'd like to thank our panel here, to Neil, James, and Adnan for their participation and the useful insights on this, and to the audience here for engaging in a very lively discussion and debate. So yeah, and with that, I'll turn back to David to give some concluding remarks. But thank you.
Well, thank you. And it was a very lively debate, and we made full use of the microphones, as I had hoped we would do. It's been a very good way, I think, of launching some subjects which we maybe didn't get into so much in the actual survey. And I think the discussion about data and the blockchain and the way to maybe overcome greenwashing through this extra accountability, which has been brought up, is totally fascinating. One thought that I have, of course, is that the public sector investors are somewhat counter-cyclical because of the deep pockets you have. And therefore, when one is saying that you are taking this more cautious view, whether actually this is masking a risk-on approach, which you might have, on the basis that nothing is quite what it seems. So it could be that, even though Neil's been giving this gloomy message, could be the public sector, under the masquerade of pretending to be very cautious, actually moving in to assets which they find cheap. We will know the answers till this next year, I think, when the survey comes out. So thank you all very much indeed, and do give us the feedback over the drinks that I mentioned before. We do very much rely on your ideas and your input. So thank you very much all for coming, and please do enjoy a drink outside. Thank you.
Thank you.